Hello everyone, I am Vanamal Sumsangi and today I will discuss about monetary policy and its instruments. Monetary policy refers to the credit control measures adopted by the central bank of a country. In case of Indian economy, RBI is the sole monetary authority which decides the supply of money in the economy. Monetary policy is that policy through which the central bank of the country, that is Reserve Bank of India, controls the supply of credit, availability of credit, and the cost of credit or the rate of interest in order to attain a set of objectives revolving around the growth and stability of the economy. It also refers to the money supply or credit supply policy of the government to control the flow of purchasing power in the economy so that inflationary and deflationary pressures are controlled. There are two principal instruments of monetary policy or credit control of the central bank of a country, namely quantitative instruments and qualitative instruments. Quantitative instruments of monetary policy aim at controlling the overflow of money supply or credit supply in the economy. Following is a brief discussion of some important quantitative instruments. First, we have a repo rate. Repo rate, also called policy rate or bank rate policy, is the rate of interest at which central bank offers short-period loans to the commercial banks. Rise in repo rate is often followed by a rise in the market rate of interest, while a fall in repo rate leads to a fall in the market rate of interest. When repo rate is raised, there is contraction of credit leading to a fall in aggregate demand and hence a fall in the general price level. It tends to moderate inflationary pressures in the economy. On the other hand, when repo rate is lowered, the market rate is also lowered, leading to expansion of credit as well as expansion of aggregate demand. It tends to break the cycle of economic slowdown. Secondly, open market operations. When the central bank of a country buys or sells securities in the open market, it is called open market operation. If the credit is to be contracted, the central bank begins to sell securities in the open market. On the contrary, if the central bank wants to expand credit, it begins to buy securities in the open market. In the event of inflation, central bank sells securities in the open market. As a result of it, credit is contracted, aggregate demand goes down and prices tend to fall. On the contrary, during depression, the central bank buys securities as a result of which credit expands, aggregate demand increases, and prices tend to rise. Thirdly, CRR, cash reserve ratio. It refers to cash reserves of the commercial banks with central bank as a percentage of their demand deposits. Commercial banks are required to maintain minimum CRR as fixed by the central bank from time to time. If the central bank wants to contract credit, it raises the cash reserve ratio. As a result, banks have to keep a larger percentage of their deposits in terms of cash with the central bank. It reduces their cash reserves. Lower cash reserves reduces credit creation capacity of the commercial banks. On the other hand, when the commercial bank wants to expand credit, it lowers the cash reserve ratio. This leaves the banks with larger cash reserves to create. And lastly, SLR, statutory liquidity ratio. SLR refers to the ratio between liquid assets and total assets of the commercial banks. The commercial banks are required to maintain minimum SLR as fixed by the central bank from time to time. Every bank is required to keep a given proportion of its total assets in the form of liquid or near liquid assets. It is called liquidity ratio. When the central bank is to contract credit, it raises the SLR. On the contrary, when the central bank is to expand credit, it lowers the SLR. Quantitative instruments of monetary policy aim at controlling the flow of credit across all business activities in the economy. Qualitative instruments, on the other hand, aim at controlling the flow of credit for certain specific or selective activities in the system. These are as under. First, change in margin money. The result is that the borrowers are given less money in loans against specified securities. For instance, raising the margin requirement to 70% means that the pledger of securities of the value of rupees 10,000 will be given 30% of their value, that is rupees 3,000 as loan. In case of recession in a particular sector, the central bank encourages borrowing by lowering margin requirements. Secondly, rationing of credit. Rationing of credit refers to fixation of credit quotas for different business activities. It is introduced when the flow of credit is to be checked, particularly for speculative activities in the economy. The central bank fixes credit quota for different business activities. The commercial banks cannot exceed the quota limits while granting loans. Thirdly, direct action. The central bank may initiate direct action against the member banks in case these do not comply with its directives. It includes the recognition of a commercial bank as a member of the country's banking system. Last but not the least, moral suasion. Sometimes the central makes the member banks agree through persuasion or pressure to follow its directives on the flow of credit. The member banks generally do not ignore the advice of the central bank. The banks are advised to restrict the flow of credit during inflation and be liberal in lending during deflation. These both methods affect the level of aggregate demand through the supply of money, cost of money, and availability of credit. Thank you.